Consumers are bullish on the housing market. Hedge funds are suing the government over Fannie Mae and Freddie Mac. And if you're time-strapped during earnings season, what's the one bank to watch? You're in the right place, folks, because this is where the money is. David, starting off with earnings season, which kicks off this week, we're going to see Wells Fargo and JP Morgan among the big banks reporting this week, but then we're going to see everybody start to report shortly after that. For investors that are strapped for time but want to read on the banking sector, what is the one bank to tune into? What's the one earnings report to tune into? I
think the clearest one to watch is Wells Fargo. It's a pure play on banking, more so than a Citigroup or a JP Morgan Chase. This bank focuses on the American consumer, American businesses, the American mortgage market and housing market, as you mentioned in the intro. And I think it's really going to be a good gauge of not just where the banking sector is going to be in this earnings season, but where the entire earnings season for other companies is going to be when we see those earnings start to come out at the end of July, beginning of August. So I think Wells Fargo is going to be a good one to watch.
I think you're right, and I think you're thinking about this the right way. When we think about Bank of America, there's still the repairing the business, getting past the legal issues, so that's going to be very specific to Bank of America, that earnings report, or at least a lot of that earnings report. Same thing with Citigroup. You've got the Citi holdings, a lot of still repairing and getting past crisis-era problems there. But I like JP Morgan to tune into. So you've got a lot of the same exposure at JP Morgan that Wells Fargo does. It's the #2 mortgage originator. It's got a big credit card business. It's got a great banking business, a business banking business. And then it's also got the capital markets exposure that Wells Fargo doesn't. And while some people may look at that as skewing the results, I feel like that gives us one extra read on the entire banking sector. So you've got kind of the entire rainbow, if you will, maybe a double rainbow, if you will, over at JP Morgan. And one other that I'd throw out there that flies under the radar a little bit, that would be a more direct read on the banking sector, more similar to Wells Fargo, is U.S. Bancorp. Very straight as an arrow kind of bank that I think would give investors a good read on the sector.
Absolutely.
So sticking with the housing theme, 93% of consumers think that this time next year housing prices will be where they are or higher. That's according to a report from Fannie Mae. Is it too late to be bullish on the housing sector?
I don't think so. I mean, you look at that same data. The data point that stood out to me was consumers' expectations of where prices will go over the next 12 months. So the average consumer, I guess, expectation was a rise of 3.8% over the next 12 months, and that's doubled from what it was June of 2012. So June of 2012, the expectation was 1.9%. So it's obviously gaining steam. I think people are looking out there and just getting more confidence. I really think that's what the name of the game is with the housing sector is, are you confident with your mortgage, with your house, and are you willing to look to buy a new one, to look to sell? So I think there is still a lot of confidence to go.
I like the confidence angle. I think that's what we need to get the recovery in motion a little bit more than it has been. I guess the one thing that you know, if I was to rain on the parade a little bit, is that when you look at, you say, okay, expectations are building, and particularly when you're talking about consumers, they're often a little bit late to the game. So, you know, that's the one thing that I wonder about. But when you look at the trough that we hit during the financial crisis, and you look at the recovery so far, I would have trouble saying that we're looking towards any sort of overheated market or bubble type of market quite yet. So I guess on the balance, I'm more positive on it than I am otherwise.
I think the other interesting point in the survey was expectations of where mortgage rates will be. Obviously, we've seen a spike in interest rates over the last couple of months, and 57% of respondents thought mortgage rates would be higher at some point in the next 12 months. And that's up from only 46% in the last month's survey. So obviously that might serve as an impetus for people to go out there and get that home that they may have been sitting on the sideline for if mortgage rates continue to tick up.
Consumers talking to Fannie Mae about the future of housing prices aren't the only ones that are bullish these days. The hedge funds and private equity funds investing in Fannie Mae and Freddie Mac, particularly the preferred shares of both of those, they're bullish. They're bullish on the housing market, and they're bullish on what that means for Fannie Mae and Freddie Mac. They're so bullish that they're suing the government to try to get these two mortgage giants back on the private market. Do you think this is a strategy that's going to work?
I think it may. I know you're not a huge fan of buying the common shares of Fannie Mae or Freddie Mac. Basically a speculation play in terms of whether those get reprivatized and those common shareholders get some money in the end. And I think it's interesting that you have that on one hand, whether they get reprivatized and they're still entities, and this other hand, you have entities suing the government. And the Corker-Warner bill, it's been laid out now, and Corker and Warner, they've come out and said, we don't really care about the economic interests of those people speculating. That's a whole separate issue. So I think for individual investors, I think the end goal may be settlements, and I'm not sure how much, obviously hedge funds have a little different skin in the game than individual investors, so it may be harder for individuals out there holding these common shares to wheel and deal with the government as opposed to a hedge fund like Perry Capital. They have a little bit more resources.
I think it's the strategy that you have to go with. If you're a hedge fund and you've got the money to back the lawyers and the lawsuits, and maybe we'll see some. We've probably seen some class actions so far. We'll probably see some more class actions going forward in terms of the common shares. But bearish is the only way to describe it. I would prefer to look at companies that are currently on the private markets, that are currently earning profits that they can distribute to their investors. And I'm not interested in this idea of betting on a government battle and whether the government's going to decide, okay, well, we'll put these back on the private market, even though we have no intention of doing so. So yes, bearish is the way to describe my position on that. In the Wall Street Journal today, there was a story about employees of big banks being restricted in terms of whether they can invest in the company's funds, in the bank's funds, internal funds. And this ties back to the Volcker Rule. Is this something that you see as a concern in terms of employees being disincentivized internally via the Volcker Rule?
When I step back and look at the Volcker Rule from whether I'm going to make an investment in a bank, personally it doesn't really factor in to what my outlook is for the bank. You think about a bank like JP Morgan, a lot of people might think this is a hugely risky bank. We had the London whale incident. Yes, it was a black eye, but 80% of their revenues come from basically boring banking business. It's not necessarily these risky trades that internal private equity groups and crazy derivative trades that they're making. A lot of it's boring banking. Same with the Bank of America. They've spun off their private equity arm of BAML Capital Partners. So going forward, I really don't think if the Volcker Rule, we don't even have the set rules for this yet, even 2 years later, even when it does happen, I don't think it's going to be a huge hit to banks' earnings power, especially a bank like Bank of America, JP Morgan. They're big enough to weather a storm, I think.
I think what investors really need to be watching is the definitions. It's all going to come down to definitions and what exactly is proprietary trading versus what is market making. And this can all get really tricky. And one of the big issues with the London whale situation is, what was JP Morgan doing there? Were they truly hedging, as they said that they were, with the transactions that ended up leading to the big losses? Or was that a proprietary strategy? And in an even bigger sense, when all these banks are doing their market-making activities, which are very profitable activities, is that proprietary trading, or what of that is proprietary trading versus what is market making? And there's been some talk as well about just the idea that banks shouldn't be market making. Whether you want to define it as proprietary trading or market making, that these big banks with FDIC backing shouldn't be doing it. Now, if it boils down to that, if it comes to a point where it's banks shouldn't be market making, then we get to this idea of spinning out those divisions. And I'm not sure that investors should be overly concerned about that, because if you spin off what's seen as dangerous and risky operations, that could be beneficial to investors in terms of having a clear bank here and a clear market-making operation over here that people can invest in, and they can value on on the basis of those individual operations. So, I think there's a lot of pessimism around something like that happening, but I think that that's not something to necessarily worry so much about.
Great.